How to buy rentals with no income verification. I'm Dave Holland, licensed mortgage and real estate broker with 25 years in the business. If you're self-employed, a real estate investor, or somebody whose tax returns make you look like you make zero money, even though your bank account says otherwise, this video is going to make you feel like somebody finally turned on the lights. Because there's a loan product that does not care what your W-2 says. It does not care what your tax returns show. It only asks one question: does this property make money? If the answer is yes, then you can get a loan. Let me break it out for you. What is a DSCR loan? DSCR stands for Debt Service Coverage Ratio. I know, that's a lot. It's a loan product designed for real estate investors that qualifies you based on the property's income, not yours. The lender looks at gross monthly rent that the property generates, compares it to the total monthly payment, which is principal, interest, taxes, and insurance, as well as HOA if it's applicable, and they calculate that ratio. A DSCR of 1.0 means that the rent exactly covers the payment. A DSCR of 1.25 means that the rent covers the payment and then some. Most DSCR lenders want to see at least a 1.0 to 1.25 to approve the loan. This means that the property is going to pay for itself. Some will go below a 1.0 for strong borrowers or borrowers that have significant reserves or money. The higher the ratio, easier the approval. Here's the part that changes everything for investors. Your personal income is not part of that equation. No tax returns, no W-2s, no pay stubs. The property qualifies for itself. So who is this for, really? Let me give you some profiles that I see use this product the most. First is going to be your self-employed borrower, right? So you own a business, you write off everything that's legally possible, and your adjusted gross income on paper is $60,000 a year, even though your business generates $300,000, $400,000, $500,000. So conventional financing looks at that number and they're like, this person makes $60,000 a year. They laugh you out of the room. DSCR looks at the rental income on the property that you want to buy, and they ignore those tax returns completely. That's a completely different conversation. Second, the investor who owns properties already. So if you've got 4, 5, 6 rental properties, you're already having a lot of write-offs. Conventional financing starts putting limits on you at a property number 4 in many cases. And the debt service from your existing portfolio makes your DTI look terrible, even if every property cash flows. DSCR sidesteps that by analyzing each property independently. Third, the high earner with complex income. So let's say you make a lot of money, but you have commissions, you have bonuses, K-1 distributions, multiple income streams, your taxes are crazy. None of it's documents cleanly on a conventional loan application. DSCR doesn't need any of it. The terms that you should know going in. So DSCR loans typically require 20% down, sometimes 25% depending on the lender, the property type, the borrower. Your credit score matters more here than on a conventional loan typically because the lender's taking more risk. Think about it. They're not asking for all of the typical tax documentation that's a for sure thing for them. So without that income verification, most DSCR lenders want to see a 660, 680 or above, with your best rates typically kicking in around a 720 or 740 score. Rates on the DSCR loans, of course, they're going to be a little bit higher than a conventional because of the risk profile. But if you look at taxes and paying a lot of property taxes or paying a lot of income tax versus that risk profile and paying a little bit more interest, I'll take the interest any day. Typically, you are looking at conventional plus maybe half a point, maybe a full point depending on the lender and the loan type, the loan size, your credit profile. That spread has narrowed more in the recent years, but you need to go in expecting a little bit higher cost than a conventional investment loan. One thing I really need to be clear about: DSCR loans are for investment properties only. You cannot use this loan if you want to buy your primary residence and go live in it. It's strictly for rentals, short-term rentals, and commercial units structured as investment vehicles. If you're looking to move into a property, house hack, do anything like that, we need to be looking at a different product for you. So we could still do it, we just have to look at something else. Short-term rentals and DSCR. Here's a question that I do get a lot. Can I use a DSCR loan for an Airbnb property? The answer is yes, but with some important nuances. Some DSCR lenders will accept the projected short rental income, sometimes called STR income, based on market data from tools like AirDNA or other tools that are available to the lenders. Other lenders want to see 12 months of actual rental history on the property. The market for STR, DSCR loans has expanded significantly, but you need a lender who works specifically with this product type, and not all of them do. So how to use this strategically? Here's the play that I see sophisticated investors run. They max out conventional financing on their first 2 or 3 properties, building a core portfolio. When conventional financing starts to get too restrictive, then they pivot to DSCR for acquisitions 4 and beyond. The DSCR portfolio grows independently on the cash flow of those properties. They build 2 parallel stacks of assets. Pair that with other products. Let's say if you qualify for VA loan and the wealth building strategies that are available for that I covered in my last video, and you have a complete framework. VA benefit for the primary and house hacking, conventional for early acquisitions, and then DSCR for scaling past the conventional limit. You can do this with other loan types as well, but we happen to specialize in VA. That's how you build a real portfolio. So the bottom line, if your tax returns are working against you instead of for you, or conventional financing has finally hit its ceiling for your portfolio, then DSCR may be the workaround. It is the right tool for the job. The product exists because the mortgage industry recognized that real estate investors create income differently than W-2 employees, and the underwriting needs to reflect that. So, worst case scenario, you get on a call with a broker who specializes in investor financing, you find out that your target property has a DSCR of 0.9 or 0.6 or 0.75, and it doesn't qualify. Some of them do for those lower DSCR ratios. And you either pass on the deal or you adjust your offer price. That's free education that you get that saves you from a bad investment. Best case scenario, you're under contract and in your next rental for 30 days. The link is in the description. No obligation, just answers. Subscribe for new content. Every week we release on the mortgage and real estate topics that actually move the needle. I'd love to chat with you. Thanks.